through a series of executive orders, Donald Trump has made his support for fossil fuels very evident. He has dismantled support for cleaner energy and for Biden-era climate policies, ranging from drilling in the Arctic to lifting LNG export restrictions, as he said. He wants to drill, baby drill, and use the liquid gold to make the United States rich again.
Hello, welcome to the third episode of Oil Insights in 2025. I'm your host, Vincent Wu, and today I'm joined by fellow research associates Mita Dowding and Mita Chaturvedi. Our usual host, Harry, remains on travel this week. Before we start the show, please like and subscribe to the podcast. I invite you to also visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content, including Harry's travels. At the time of this podcast, front-month Brent futures were trading at around $79 per barrel. Price action has seen a lot of downsides this week as traders weigh on Trump's first days in office, taking profit on the recent rally. Notably, front Brent spreads have also sold off below $1, indicating that market tightness concerns are easing and that the recent rally may have been overbought. On Monday, January 20, Trump was sworn in as the 47th President of the United States. His re-election has reverberated around the financial markets, from equities, bonds, currencies, commodities, and crypto. On this show, we discussed the effect on the oil market and trade ideas in depth in Season 1 Oil Insights, episodes 11 to 13. The contents of Trump's inauguration address were no surprise, but they will continue to bring market uncertainties. On day one, he issued many energy-related executive orders, in effect reversing Biden-era regulations and to prioritize US energy production. Trump declared a national energy emergency, vowing to drill, baby drill. He reversed Biden's ban on oil drilling in the Arctic and off US coasts. He promised to refill the SPR right to the top. He lifted a freeze on LNG export permit applications. He once again withdrew the US from the Paris Climate Agreement. He also took aim at electric vehicles, revoking Biden's executive order, which aimed for all EVs sold in the US by 2030 to be electric. In a blow to the US's decarbonization efforts, he suspended federal offshore wind power leasing. Some of these orders will be examined in this episode. Tariffs and trade policy will complicate things. Although no tariffs were imposed on day one, Trump threatened 25% tariffs on Canada and Mexico and 10% on China from the 1st of February. Trump repeated his vow to take back the Panama Canal, citing US security concerns in one of the US's most important trade routes. Given the integration of global oil markets, Trump's trade reforms will not only affect supply and demand balances, but also reconfigure trade flows and geographical arbitrages, which will be discussed today. Finally, Trump declared that he wanted his legacy to be known as a peacemaker and unifier, referencing the Gaza ceasefire deal and his intention to end the war in Ukraine. But what of his stance towards Iran and Venezuela, where he is widely expected to intensify sanctions? The market was already tentative and adding long positions to Brent futures, and the recent sanctions on Russia's shadow fleet fanned the bullish flames. So Martha, in last week's podcast, we commented that money managers had added length to Brent futures, and I assume this was the case again for the most recent data.
Yeah, so the most recent data is for the week to the 14th of January, so as you said, prior to Trump's inauguration. And money managers, so speculative funds, continued to add both long and short positions and were risk on generally in the week. So they added just shy of 37 million barrels, which is about 11% to length, and also added about 2.5 billion barrels, which is about 3% to their short positions as well. So risk on around the board. And this brought their net positioning to, let me get the numbers right, 272 million barrels from 238 million barrels in the week prior. And this is quite significant and brings us to the highest net positioning we've seen from speculative funds since April 2024.
Yeah, wow, that's quite high. So I take it that the long-short ratio has moved high as well, leading to an overbought market?
I don't think we're necessarily in overboughtness by the 14th of January. We're looking at the long-short ratio from these managed by money players. That's increased from 3.73 to 1 in the week before to over 4-1, and this is the first time again since April. Looking at all weeks since 2013, this is in the median 50th percentile, which is a nice statistical thing. So we're looking at the market that is really, really balanced from a speculative market, and they're able to work their way out from negatives that we've seen, within memory. So we're looking at a really balanced market in terms of managed by money positions on the 14th of January, that is.
Certainly. So the ICE-COT data only runs to last Tuesday, but we can always turn to Onyx's proprietary estimates with respect to our CTA model to see if risk takers have further increased their length in Brent and other oil futures. So Martha, what's our CDA model suggesting?
Yeah, so looking at the CTA model that we have, net positioning has increased with really decent strength, and we haven't seen a high like this since last April. CTA movements have been quite flat, but they get the most exciting when we see these huge peaks and huge troughs, and it has corrected a bit since the high on the 17th. It was the net positioning for the combined futures, which we look at the total of because it's the most indicative of net positioning total. It was about 125,000 lots on the 17th, and it's down to about 84,000 lots now. So we have seen that sell-off begin from the CTA model, model that we have. Interesting, the component of, as I said, this is a total of a few components. The RBOB component, the net positioning there has flipped negative, which would be interesting. But this sell-off that we've seen has been really significantly from Brent, but also TI. Brent has sold off more than TI in this sell-off since the 17th, but heating oil continues to be really strong and net positive in the net positioning.
Well, that's quite interesting. So overall, I take that its positioning was quite bullish, but then now the momentum is definitely waning.
We have seen it sell off a bit, but it could just easily be kind of a recorrection before more strength comes into the market. These are the levels that you really need to see. Is it a correction or is it a sell-off? Because then we can see once they sell off, they sell off, and we can see some real weight move out of the market, real length move out of the market.
Of course, and yeah, for more in-depth analysis, our reports do cover a lot of these spaces.
Definitely.
So, of course, speaking of which, on the more technical parts, our reports do have a lot of these spaces covered. So now that we have spoken about positioning, we have set the context, let's talk more about Trump's policies and what he has done in his first few days in office and our analysis on that. So Trump has issued a flurry of executive orders fulfilling campaign pledges and reversing many of former President Joe Biden's orders. So we'll focus specifically on energy-related policies, as mentioned during the intro. So he signed orders declaring a national energy emergency and to unleash American energy, reads fossil fuels. No president has ever declared a national energy emergency, but regional emergencies were declared during the 1970s in the oil crisis. The orders would help circumvent the usual environmental and other regulatory and permitting procedures. And with the US naturally long in crude and natural gas, Trump intends to export America's energy surplus and with that help address its trade deficit. He said we will bring prices down in his inaugural speech. So Mita, all other things being equal, how viable do you think this is?
Thank you, Vincent. I think considering how significant this event has been, I'm going to break it down a bit more to explain things. Firstly, yes, through a series of executive orders, Donald Trump has made his support for fossil fuels very evident. He has dismantled support for cleaner energy and for Biden-era climate policies, ranging from drilling in the Arctic to lifting LNG export restrictions, as he said. He wants to drill, baby drill, and use the liquid gold to make the United States rich again. He has promised to cut American energy costs by half by this year, within the year, and has claimed that drilling is going to help him achieve this goal, while, as you said, exporting America's energy surplus and thus addressing its trade imbalance. The problem with this is that the US is already producing a record amount of oil and gas. In March 2024, the EIA released a report detailing that the United States produced the most crude oil of any nation in the world, with no other nation with the production capacity to match it or surpass it. More recent data by the EIA also shows that production is at a record high in the US, as we can put on the screen. Recent growth in global oil production over the past couple of years have primarily been led by the Americas, that is, namely the US, Canada, Guyana, and Brazil, and the four of them increased their total liquids production in 2024 by a combined 1.1 million barrels a day. However, recent forecasts, so the EIA's most recent forecast, for example, expects this figure to slow down over the next couple of years for a multitude of reasons. So in the US specifically, crude oil production could flatten due to operators reducing the number of active drilling rigs if prices fall. Furthermore, aging basins like the Permian Basin, for instance, is growing, but at a slower rate compared to the past 15 years. So the decline in production in basins like these could be even more severe than other basins around the region or other shale basins. We could perhaps see reinvestments in oil and gas rigs that could address this slowdown. There is some hope that this new administration could lead to a flurry of new oil and gas exploration permits and new investment that comes into the industry. But such growth would require immense capital spending. Rystad Energy found a scenario where Permian rigs rise by 60 more month on month relative to their current forecasts. And this could see a production upside of around 343,000 kilobarrels per day by the second half of 2026. It would also cause capital spending to rise by over $11 billion. Such money would have to come at a time where consumption and demand for oil is also put under a microscope for all the wrong reasons, with the adoption of EVs and tepid manufacturing demand lately. An overproduction of oil would lead to a decline in shale production budgets. These producers are also businessmen. They will have to prioritize their own revenue streams and their shareholder values. So if prices fall under $70 a barrel due to an overproduction, operators may have to cut back on lower 48 drilling. So to answer your question, producing more would require investment in its current state, but this investment would be just difficult to justify if prices are low enough to adversely impact producers. If in such scenarios, these producers will choose to produce less, I guess cutting as per demand and their margins, we'd end up in a scenario where we see a natural floor for prices, which I guess in terms of political power and political viability would be good optics to have gasoline, despite the journey that it would take to get there. It'd be good optics for a US politician for gasoline prices to decline. So I guess that's your political viability and why Trump wants to do this.
Yeah, certainly. You're right on many points. There's a lot of this is all based on optics, but at the same time, sure, there's an improved regulatory environment for more drilling, for more of this upstream investment. A lot of these companies are also private companies who are also focused on capital discipline and also have their shareholders to, let's say, please or provide to, so there's accountability there. And also, I suppose Trump wouldn't really want oil prices to go too low, as we recall during the COVID times back in 2020 when prices were collapsing. He sort of during the OPEC price war, he really incentivized Saudi Arabia and Russia to come to a deal and of course to cut production. So because low prices would also be hurting these shale producers who Trump would like to benefit the most as well. So there has to be a balance there somewhat. But of course, oil is not just a singular flat price. And in the world of oil derivatives, it's all about differentials as well, where a lot of trading opportunities lie. Different geographies and time periods have different prices. So that includes within the US as well. So even if that price moves in a binary up or down direction, this would also affect sweet versus sour crude differentials, the different qualities of the crudes, so different properties. And as we discussed in Brent Dubai last week, for example, so now Trump has talked about imposing 25% tariffs on Canada and Mexico, with oil not exempted. So Mita, how do you see US crude differentials changing should these tariffs materialize?
Yes, of course. So the current expectation is of 25% import tariffs on Canada and Mexico. In 2024, around 4 million barrels per day of crude oil and oil products were imported from Canada alone. And a lot of the United States' refineries have slates that are compatible with heavier crude oil, such as that in Canada. So should the tariffs limit the flow of more sour crude into the US, it may lend support to the country's native heavier crude grades. So that's the standout differential, according to me, would be the differential between Mars, that is the US Gulf Medium sour crude blend, which arrives via the Mars pipeline in Louisiana, versus WTI. Mars is the most liquid domestic medium sour crude blend and closely matches Canada and Mexico's crude oil spec. Mars may be especially relevant right now because the US cannot, ironically, rely on its SPR for energy security. The SPR requires crude filled in to be produced in the US. In addition, the SPR cannot supply to Pad 1 and Pad 5 due to the infamous Jones Act, thereby requiring Canadian supply of crude to effectively act as an alternative SPR for these refineries. Therefore, heavier native crude such as Mars, I believe, would be put into the spotlight should crude flows from Canada and Mexico be impacted.
Very interesting. So again, Trump has pledged, speaking about the SPR, Trump has pledged to fill the SPR to the top. US strategic reserves, which at the top, that's 714 million barrels approximately, which from currently levels needs around 320 million barrels of buying. So Mita, how feasible or realistic do you think his plan is? Is this SPR still relevant in today's market?
So the first bit of that question, the reserve currently has around 394, just above that many million barrels. That makes about 55% of its total capacity. At current WTI price levels, Mr. Trump would need lawmakers to approve around $24 billion worth of crude to entirely refill that SPR. Purchasing that much crude could in turn drive oil prices up, completely reversing what he wants to do with this. They might choose to buy this crude over time, therefore deflating that inflationary risk. But that would take a lot more time. The API said in August 2024 that it would take an estimated 19 months to fully replenish the SPR. And this was when the SPR was at around 370 million barrels. Another thing to highlight is that Trump's not the only president to have tried this. President Biden also tried to refill the SPR, but ran out of funding after purchasing around 60 million barrels. That said, as you said, no other president has declared such a national emergency on energy before this. In terms of relevance, Donald Trump believes that refilling the SPR could protect the US against future oil price shocks, which is essentially the point of the SPR's entire existence. However, 1973 was a very different time in the US in terms of oil price shocks. The oil embargo necessitated the need to have an oil reserve, but the shale revolution and the fact that the United States is the world's biggest oil producer softens that importance for the SPR. Many in the market believe that market forces and private stockpiles are sufficient to shield the United States from a negative supply shock. But it'd be really difficult to politically to remove and to be completely done with the SPR. For instance, right after Russia's invasion of Ukraine, Biden authorized an emergency release of 30 million barrels from the SPR. Later that month, he approved the emergency release of up to 1 million barrels per day for 6 months, which was about 180 million barrels, the largest release in the reserve's history. So stuff like that, having that political tool in your arsenal, I think has given, especially after hurricanes, for example, has given the US that ability to at least have this safeguard against price shocks. In addition, some other analysts believe that without the SPR, the government would have to ask companies, private companies, to hold more reserves, which could then increase their costs and prove to be a really unpopular thing to do for them. Also, these private stockpiles would have to be stored somewhere, some of them above ground, which could lead to a shorter shelf life compared to the salt caverns that the SPR is stored in, which allows this oil to have a longer shelf life.
Quite interesting. Thanks for these insights, Mita. So it seems that putting these policies into action is quite complicated in reality. So, and of course, with respect to price action, there's conflicting factors on both sides. Pro-drilling policies may lead to lower prices, but then SPR refills and maximum sanctions may yield to higher prices. So, of course, the Trump administration is fostering a fossil fuels rhetoric and creating a supportive regulatory environment for that. But much uncertainty still remains about how price action in both flat price and the differentials will play out. So on to more of the international trade scene. Earlier we did mention tariffs on Canada and Mexico, and Trump has also considered a 10% tariff on Chinese imports as well from the 1st of February. Still, this is much lower than the 60% he said on the campaign trail, and a lot of uncertainty as Trump intends to use tariffs as a negotiating starting point, but traders will be anticipating these, and there would be, should the tariffs be implemented, a material impact on supply and demand and global trade flows, not to mention inflationary pressure and the effect on currencies. So the petrochemical industry is a core focus because of the increasing integration of the industry between the US and China, where also East Asia is a major demand outlet. So, Martha, should trade tensions escalate between the US and China as well, or potentially with its other trade partners, how do you think this will affect the propane as petchem feedstock with that market and its related differentials?
I'm a bit of a tariff skeptic in terms of how much of these things are actually going to happen and how much either government can really afford for these things to happen. But talking hypothetically, if we are to see tariffs, looking to propane would be a really interesting place, especially considering the nature of the market. There's loads of different benchmarks and therefore differentials within propane. So this is just a look at one of them that we think would be a really hotspot kind of one to watch if we are going to see tariffs in this market on China, and then return tariffs on the US. So the contract that we're looking at today is the LSTCP, which is a difference between the Mont Belvieu propane in the US and the Saudi Aramco benchmark in Saudi Arabia. And it might feel like we're off by a few miles with the Saudi benchmark, not looking at the FEI, which is a bit closer. But it's more to do with looking at which of these foreign propanes can kind of fill the gap stop for China, because China is a propane producer by its nature. So when I say stopgap, of course, China produces propane itself, but it's not a net producer, it's a net importer. So it does still have to import from foreign places, and this would be interesting to see which is the most economical and therefore which will be more attractive to them. I think in Trump 1.0 this differential was really volatile. I think the situation's a bit calmer now and there are more long-term and direct contracts. So I think last time in 2018 there was this kind of flurry of activity within the AG of like swapping out cargoes, or how everything happens with sanctions and tariffs. There is always somewhere where you can swap crude around or change things a little bit to get away with it. And that place was the Arabian Gulf. China needs propane, full stop. Like, China produces loads and loads of plastic, as we're all aware. The PDH units, which are the propane dehydrogenation units of a refinery and a petchem producing plant, they dehydrogenate propane into propylene, which is one of the really important things in plastics. And there are other things as well that you can do to get different plastics. But the margins for these units are really, really poor right now. And the rates are as low as they can be without stopping. They can't stop. They're seeing, well, there's lots of reports that they're seeing even negative margins right now, and they're still running. Looking at the state of the market right now, I don't think that's unlikely. So that shows that they need the propane. They're running as little as they can, and it's not going to be a case if they just turn their units off, because that's just not how these things kind of operate usually. So looking at CP as a contract, as I mentioned, the benchmark is owned by Saudi Aramco, and at the end of every month, in a different way than say LST or FEI ends the month, the price of CP at the end of the month is set by a settlement, and that settlement is done by Saudi Aramco, and technically everyone gets it at the same time, but there's always people speculating on that. But as with any settlement price, as with any price, some people want it a bit more expensive and some people want it cheaper. Looking at countries that would benefit from CP being strong and a stronger settlement in this time would be, say, like South Korea and also Japan, as they base their, they would be basing their domestic sales on the CP prices, like kind of a differential of that. Whereas countries who would be wanting it cheaper, CP settlement prices from Saudi, would be countries like India and China, as that, they're buying it, they want it cheaper. And it's really important that to Saudi that they're not, annoying these players or kind of putting them off buying from them by testing the settlements too high. So looking to India, of course, China produces a huge amount of plastic, we all know that, but India is also a massive up-and-comer in the petchem production industry. So India's domestic petrochemical production rose by, I'll just get this right, 29.6 million tonnes in the most recent data and it's projected to have increased to 46 million tonnes by 2030. So it's really important that Saudi Aramco are kind of aware of where India wants or where India thinks the cap of the CP settle should be in conjunction with China for that kind of demand avenue.
Certainly, it's quite interesting with with the interplay between the different countries in Asia, Middle East, as well as the US, and of course, if CP prices become too high, then the netbacks will change, and that means that the US propane might be shifted towards Europe instead. So it's always the propane market, the differentials, international trade's always in flux, and with Trump coming in, this will add some more complications to the puzzle. And so in terms of the petrochemical feedstock, we talked about the propane market. Also, how might this in turn affect the naphtha market?
Well, in terms of the very basic bones of the matter, if the US imports less plastic from China, then they will have less demand for naphtha, propane, and therefore the East-West will be bearish. Looking at naphtha, we often look at the East-West as a very liquid contract within naphtha anyway. But I don't think it's that simple. I think that will they be able to turn down the plastic production, as I mentioned earlier. It's not just a case of, oh, there are fewer imports, so let's stop making plastic, let's stop buying naphtha. I think that it's more complicated than that in terms of profit margins and run rates, in terms of what can they be running these naphtha crackers at, these dehydrogenators at. So as well as the US imports, it will be interesting to see if China's opening up other export avenues within, maybe other countries that they're, favorably seen in. And outside of China, I think it's important to have a look at how these tariffs will impact the dollar. So it's more than likely that the US tariffs will cause a stronger dollar, which Trump has been out as saying he does not. He wants to weaken the dollar again because he sees the benefit of that. But not only will that be against what Trump wants, but it will also be detrimental to these to the other players buying MOPJ as well, as expensive. As the US dollar becomes more, quote, expensive from that currency. I mean, just look at, say, the Indian rupee versus the US dollar. That's seen really suffered recently. And therefore, there may be, like these countries, because everything is settled in dollars at the moment, there may be less demands because they just can't afford it.
So on to a bit of geopolitics. So given the ceasefire recently reached between Israel and Hamas, the Houthis may start to limit attacks on international shipping in the Red Sea, as we know that has been affecting crude oil prices as well as differentials in the oil products such as the naphtha East-West. So any thoughts on how this easing of disruptions may affect the oil markets?
Yeah, of course. So the ceasefire in Gaza is still standing, touch wood by the time this goes out, and it has been for just shy of a week, I think, around 5 days. There have been reports of people injured in Gaza, and there are reports of things that would be breaking the ceasefire, but they haven't kind of been ratified by mainstream media. There's not kind of, there's the narrative that the ceasefire is going to break, which I think will kind of be leaked into the media if that were to happen. So we're almost a week down, as I said. The ceasefire was initially set out to last 6 weeks. Unfortunately, we have seen growing escalation of conflict in Jenin as the Israeli forces kind of move into there, as the eyes are taken away from Gaza. And there has been some reports of injuries and on both sides here. Hamas have issued a statement calling on people to mobilise and intensify confrontations with Israeli forces and kind of criticising the Palestinian security forces for their conduct. But we haven't really seen this escalate in such a certain way that we did in Gaza, and hopefully this will be kind of diffused. So in the US, of course, they helped broker the deal and get this ceasefire. And the Secretary of State, I think, for the US has come out and said it was a joint effort between Biden and Trump, which is nice bit of handover. But Trump has kind of undermined the ceasefire a little bit in the public eye by saying that, I'll get the exact quote, "That's not our war, it's their war, but I'm not confident." Later saying, "The places, it's got to be rebuilt in a different way. It's in a phenomenal location by the sea," and kind of talks about different things, but just does kind of undermine the ceasefire in a way there by saying that he doesn't think it's going to hold. This is interesting considering his pick for the ambassador to the UN, Elise Stefanik, has told a Senate confirmation hearing that Israel has a biblical right to dominion over the West Bank. So it'll be really interesting to see how much the US is involved in the conflict in the Middle East should this continue or worsen. But yeah, the ceasefire in Gaza still stands. What impacted the market more significantly in terms of barrels at risk than the actual conflict in Gaza was the Houthi attacks in the Red Sea. We haven't heard so many of these recently. I think we have a graph to showing how they did lessen over time. And there was a case of, you could fill in paperwork to the Houthis and they'd let you in. And it all had kind of got legitified almost, but they did come out this morning or last night and say they're going to lift the ban, on most international vessels transiting the Red Sea, apart obviously from Israeli-owned or flagged. So that should be seeing some relief in the, I think, TC5 freight rate. Felt that a lot in terms of FFAs, and linked closely to that, I think originally there was some naphtha east-west movement supported by that. There has been a warning that military action by the US or UK against the Houthi would see them being targeted again. But in better news, the leader of the ship that they were keeping, they have been held captive for 430 days now, but they have been released to the crew, which is good. And this is definitely a de-escalation from the Houthis and definitely a step in the right direction. Obviously, after this is priced out of the market, after being priced in, this would leave more upside risk if there are any attacks, if they do break their own kind of rules there. So definitely keep an eye on that once the market has rebalanced.
Yeah, certainly that all seems, it's a positive development, but still relatively fragile, although it does seem to be that the Houthi news, the signaling of less attacks is a counterbalance or mitigating the recent effects of freight rally since the Russian sanctions, or the sanctions against Russia's shadow fleet.
Yeah,
so overall, the discussion can be summarized by two words: it's complicated. And this is all very, the tariffs, the policies until actual concrete tariffs are announced. But speculative traders will be looking to pre-position and express their views ahead of time, or stay on the sidelines and be in a wait-and-see mode. So this brings us to our crystal ball moment. Earlier this week, we predicted oil prices, Brent futures would close the week between $78 and $81 per barrel. Currently, we are trading around $79 per barrel. So $80 oil seemed really fragile, of course, and the bulls were bound to take profit at one point as the reality sets in that Donald Trump is back in the White House. His initial announcements were of no surprise, but this would only lead to more uncertainty and unpredictability in the markets. Given this, do you guys still think that Brent crude will hold on to these levels going into the end of Q1?
I think the tariffs being pushed to February the 1st just kind of prolongs this period of waiting almost that we're seeing now. I think that until we see whether those will happen, again, as I said previously, I am skeptical of the reality of putting these tariffs on Canada especially, but there's been no leeway in what he's been saying. It's been, 100% this is going to happen. So I think, that's going to be a huge day, February the 1st, to see what happens, or to see if, the narrative changes, like how we mentioned earlier, the tariffs on China flipped from being 100% to 10%. That'll be definitely something to watch. As normal, I am skeptical that we're going to end the quarter over 80. I think there are a few really interesting things to happen. Of course, we've seen the CTA positions turn, which could signal a big sell-off, and there almost always seen in flat price when the CTAs sell off, and when they sell off they can smash straight down into the negative net positioning. They take up a huge bulk of the market, these algorithmic traders, but we're all seeing a more balanced market overall in the CFTC as well. Refinery rates are really bad, especially in Asia, so it'll be interesting to see if there is publicly news of rate cuts, if they do or can cut rates. That'd be really interesting. But in my opinion, something that is really impactful that has happened this week that hasn't been spoken about too much, I don't think, is Trump's his Truth Social, that's it, his Truth Social post yesterday afternoon about Russia and the Russian war. And I think that this kind of is a step backwards more than a step forwards in terms of him ending the war and him saying he wants to be this great peacekeeper. In the Truth Social, he is almost insulting to Russia, saying that they saved Russia in the war, whereas I'm sure a Russian would say the opposite. He brings a completely random number for Russians that have died in World War II, and they might take that the wrong way. I think definitely if there was a rushed resolution to the conflict after this tweet, I think there's too much ego from Russia for this to happen, so I think that's going to kind of delay, or he might be being inflammatory on purpose to create a meeting to, you just never know. But I think it's definitely something that is going to be something to jump over in one way or another by making a meeting or by arguing on the internet. And that could, on one hand, push the Russian and Ukrainian war further. So there might be a little while until that's priced out of the flat price. But I still think, always a bear.
Mita?
I agree with Martha. I don't think $80 per barrel and above is sustainable in the market, even with everything happening with Russia, for example. As Martha said, we saw the additional sanctions placed. We went into $82 a barrel and then subsequently saw people taking profit. So I think geopolitical risk would have to be significantly increased for us to sustainably stay above it, especially with the narrative of overproduction and just how pro fossil fuels Donald Trump is. In addition, with geopolitical risk otherwise deflating with the entire situation in Gaza, with the Houthis, and I do think OPEC will eventually wish to increase its market share, especially if the US wants to drill, baby drill. So I do think I see more bear than bull from here.
Interesting. Thanks both for your insights. Quite bearish, and
What do you think?
I'm become a short-term bear as well.
You converted him.
Not so much. Wow, I mean,
Get ready to be wrong every week.
I think this week our thinking sort of aligned. So at the risk of repeating myself in a higher flat price environment, this will incentivize producers to drill, baby drill. The market is correcting itself after the recent bullish rush. And as we project the supply surplus, we will need to see evidence of stronger demand indicators for crude to hold on at these levels or to stay at 80. So we're looking at macroeconomic data indicators out of China and the US. How will China announce more fiscal stimulus? And with Trump in the equation, trading's become even more uncertain and volatile. Every one of his words will be combed over, and it will really be up to the market to decide whether to respond to such headlines. And so with that, we conclude this podcast. So thank you everyone for joining us today. Until our next episode, and in Harry's words, don't forget to smash the like button and subscribe to our podcast. Thank you.